Hi everyone, welcome back to the channel, and here we focus on understanding wealth system and long-term positioning, not hype. And today is no different. I want to start with something that most people never stop to think about. When engineers design a bridge, they don't begin by asking how much that bridge is worth today. They ask how much load it needs to carry, how much pressure it can withstand, and whether it will function with everything around it is under stress. So that's how real infrastructure is built. And XRP was designed using that same mindset. So if you're watching XRP and wondering why the price hasn't taken off yet, you're still asking the wrong question. The better question is, what was this system built to handle when pressure shows up? So that's exactly what we are going to break down today. Now, before we go further, let me be very clear. This is not financial advice. This content is purely educational, meant to help you understand how financial systems are designed so you are not reacting emotionally to short-term price moves. And if content like this helps you think more clearly, make sure to like the video, subscribe to the content, and comment below. So I'd really like you to know, do you see XRP more as a short-term trade, or are you starting to view it as the infrastructure? So all right, let's get into it. Most retail investors look at assets from the outside in. They focus on charts, candles, price levels, and short-term loyalty instructions. To the opposite, they analyze assets from the inside out. They ask questions like, what problem does this solve? How does it behave under stress? Can it move value at massive scale? And can it function when markets are unstable? That difference is in perspective explains most of the confusion around XRP. So XRP has never designed to act like a speculative asset first. It was designed to function like financial plumbing, the part of the system nobody notices until it stops working. Once you understand that price action stops being the main signal and functionality becomes the focus. So let's talk about how institutions define value, not price. So large financial systems don't fail because prices drop. They fail because money stops moving. Settlements slow down, liquidity fragments, slippage increases, counterparty risk explodes. At institutional scale, these are not minor problems. They are catastrophic. That's why institutions define value very differently than retail investors. Retail asks, what can I sell this for later? Institutions ask, can this asset move massive flows without breaking the system? So XRP was engineered to answer that second question. It isn't a company. It isn't equity. It doesn't represent ownership in a Ripple. It's a liquidity instrument. And liquidity instruments come with the critical design requirement that most people miss. They must scale in value and volume increases. XRP has a fixed supply, which means it cannot support larger flows by creating more units. The only way it supports scale is by each unit representing more value. That's not speculation, that's system design. So when someone asks why XRP is still around $2, they are still thinking like a consumer. The system is asking something very different. Can this asset support global liquidity when stress hits? So that's why the build happened first. So long before price reflects it, I'll keep repeating this because it matters. When it comes to XRP, certainty matters more than perfection. When systems come under pressure, decision makers don't look for perfect solutions. They look for certain ones. In times of financial stress, currency instability, liquidity shortages, geopolitical shocks, speed and certainty matter more than theory. So this is where regulatory clarity is often misunderstood. Institutions aren't waiting for a perfect global rule book. So they are asking, can we legally use this asset today? Will it settle smoothly? Will it hold up if volume spikes? So does it reduce risk of introduce new risk? XRP already answered one of the most important questions. Institutions care about That's correct. A court ruled that XRP is not a security. That doesn't matter. Yeah, that doesn't mean every regulation is finalized, but it removed uncertainty where it mattered most. In a crisis, certainty beats perfection every time. That's why assets with legal clarity becomes more attractive during periods of stress. Not because they're trendy, but because they are usable. When money has to move fast, no one wants to experiment. They rely on tools that have already cleared legal and operational hurdles. Yeah, so that's also why infrastructure assets don't explode in price overnight. They are quietly integrated into systems before anyone needs them. And once they embedded, behavior starts to change. So let me pause here for a moment because this part is really important. So understanding markets at this level isn't about staring at charts all day. It's about understanding structure, yes, risks, and how decisions are made under pressure. That's why learning how markets actually function matters. Not just signals, but skills. Technical analysis is useful, yes, but without structural understanding, it's incomplete. Now, let's keep going. Here's where retail and institutions really disconnect. Retail asks, how high can this go? Where do I sell? What's the next move? Institutions don't start there. They ask, what role does this play? How does this reduce friction? What problem disappears if this works? So XRP was designed to act as a bridge, not a bet. So a bridge doesn't care whether traffic is light or heavy. It's engineered to support flow, especially when pressure increases. In cross-border finance, pressure builds fast, currencies fluctuate, liquidity dries up, settlements delays becomes costly. That's when bridge assets matter most. And here is something many people don't realize. Institutions are not trying to profit by flipping settlement assets. They are trying to move money safely. If a bridge asset is unstable, liquidity or legally uncertain introduces risk instead of opportunity. So that's why institutions prefer deep liquidity, predictable settlement behavior, and higher national value per unit. Higher value isn't about hype. It's about efficiency. If you're moving billions, you don't want to move millions of units. You want fewer units representing more value. So that's how large systems remain manageable. So when price stays quiet while infrastructure develops, that's not failure. That's how adoption works. Usage comes first, behavior changes next. So price adjusts last. Once you understand that sequence, you stop treating XRP like a stock chart and start seeing it as a part of a system being positioned for scale. One of the biggest mistakes retail makes is assuming that if price isn't moving, nothing is happening. Institutions don't operate primarily on open exchanges. They operate through custodians, OTS, DAS, structured products, and private agreements. These flows don't show up as fireworks on the chart. In fact, sudden aggressive price movement during positioning would actually be a problem, not a success. Institutions want stability, low slippage, predictable settlement, and quiet absorption of supply. So that's why infrastructure assets often look boring right before they become important. So silence doesn't mean inactivity. It means controlled behavior. Retail is conditioned to expect excitement, but large systems don't announce themselves. So they prepare. And that's why price discovery usually happens after positioning is complete. So by the time price moves, the groundwork is already laid and behavior has already changed. So let's bring this all together. What you're seeing with XRP isn't a price story. No, it's a design story. It's about how systems are built, how infrastructure is tested, and why assets meant to function under pressure don't behave like speculative trades. So retail watches charts, institutions watch systems. Retail looks for excitement, institutions look for reliability. And when you shift your perspective, the noise fades. So silence stops feeling like failure, slow progress stops feeling like stagnation, patience stops feeling passive, In fact, patience becomes a strategic advantage because you're no longer waiting for validation. You understand the process. And that's the difference between reacting to markets and positioning within them. So if this kind of thinking resonates with and you want to keep improving how you understand market structure, cycles, risk, and decision making, make sure you stay connected to the channel. So we focus on clarity, not hype. A long-term thinking, not emotional reactions. All right, that's all for today. Stay sharp, stay patient, and I'll see you in the next one.